Okay, so let's continue. Now, let's look at like 5 practical scenarios when it comes to revenue recognition. The practical scenarios. Now, the first practical scenario we are going to look at is what we call sales sales and right of return. So they can give us a scenario like this in the exam. Sales and right of return. And what do we mean by sales and right of return? Look at it. It means that you sold goods to a customer, but in the agreement somewhere, you have given the customer a right to return. So the customer can actually return the goods to you. Okay, that's sales and right of what? Return. So in that case now, how do you recognize revenue, or how much do you recognize revenue? So one thing is sure, the customer will have paid you, abi? So you'll have probably debited bank. However, you will recognize revenue. Fine. But this revenue you are going to recognize must exclude the portion that can be returned. The revenue you would recognize must exclude the portion that can be what? Now, but the customer has paid for it. Let's say the customer paid 100 naira and the portion they cannot return is 70 naira. The portion they can return is how much? Is 30 naira. So that portion they can return, you credit it to a liability account. You can call it a refund liability account. You recognize and you put it as how much? Refund liability. Because when the customer returns, what do you happen? You refund the customer. So they can give you this scenario. It is this straightforward. Okay? You debit bank, credit revenue, you credit refund liability. Okay? Okay. Okay.
So in situations like that, how do we account for that?
I didn't get it. So you want to return and collect back all your
All
money.
your money, yes.
Okay.
What
So
leverages are there?
okay. So what she's saying is that if you can return everything, Abby, if you can return everything, so that means you will not recognize anything as revenue. Everything will be a refund liability until that period has lapsed. Okay? Until that period has lapsed. Because if they can return and it's there, that within first 6 months or first 2 months, you can return. Just debit bank and credit refund liability. Waiting for them. So if they don't come, you take it to revenue. Good question. Good question. Okay. If the customer now return, if the customer actually returns, how do you then nil off this refund liability if the customer returns it? So that means you have to pay the customer, Abi? You credit bank and debit refund liability. Okay, is that all? If the customer returns the goods. Who said inventory? That's correct. Yes. You need to update your inventory also. So that means your statement of financial position, your inventory will go up. And don't forget, your cost of sales, there's inventory there too. So inventory will impact your cost of sales too. Okay? Fantastic. That is all for sales and right of what? Return. It's not so difficult. It's practical. Now, the second one I want us to look at that they can ask, this one they ask often, is warranties. Warranty. I know Mr. Ibrahim has taught you IS 37, right? You have forgotten. Yes. Ah! Hey, my God. You're not reading. Okay. Warranty. Let's look at warranty. So, you see, you know what warranty means generally. Warranty ordinarily means that we are guaranteeing you that these goods will work very well. If it doesn't work very well, you can return it within 1 year. Okay? Warranty. So now, when we have a warranty, okay, there are some that is usually like a standard warranty, whereby you have promised the customer that the goods will work based on agreed specification. It will work in a certain way. It will work for, I mean, that is a standard warranty. You see, those type of warranty, or there are some warranties that are even required by law. Okay? So those type of warranty does not affect your revenue at all. All you need to do is just to account for those warranty in line with IAS 37 provisions. You only make provisions for them. You only do what? Make provisions for them. Warranties that you tell the customer that okay, this thing will work in certain way for 2 years or for 1 year. There's 2 year warranty on this product. There's 1 year warranty on this product, and or there's a law that says that you must. That law doesn't exist in here. In most advanced countries, it will that you must give this product warranty, right? So those ones you recognize them as what? Provisions. IS 37. However, there are some that, okay, to make it easy, when that warranty period lapse, okay, some customer will want an extended warranty. They are ready to pay for it. And they charge. I think Apple does it, right? If you buy your new iPhone, right, for a year or two, they will tell you it's under warranty. After that 1 year or two, they will tell you your warranty has expired. They will say, if you want to continue to enjoy this warranty, pay $5 per month, pay $7 per month. Okay? So those ones now, we will see that as a separate performance obligation. We will see that as what? Separate performance obligation. And if a customer should key into that separate warranty or that extended warranty, you recognize that one as revenue separately in your books. And that is it about warranties. That is it about warranty. Okay? I think there's a question here we can look at on that in the notes to clarify extended warranty. Okay, there's an example on page 126 of our handout. There's an example on page 126 of our handout. Can you open it up? Who is there? 126 of our handout. Yes, it's Premaco. Are you there? Yeah, take read. Yeah, you take read. Your voice too. Yeah, you take read. Your voice too. Yeah, give it to that man back there. 126. It's
Okay.
Premaco, right?
Yes. Premier Co sells a machine to a customer for 106,000 naira, which is the standalone selling price of the machine. The sales contract includes a warranty that provides assurance that the machine complies with agreed upon specifications and will operate as promised for 1 year from the date of purchase. As the customer represents new business to Premier Co, it also offered an additional extended warranty at no extra cost, which guarantees the machine will operate as expected for a further 6 month period after the standard warranty has elapsed. 6 month extended warranties are normally charged at 4,000 naira.
No requirement. Okay, no problem. So I mean they have passed their information. So there is a standard warranty from that question you read. There's one that is standard that they are assuring customers that the product will work based on agreed specification. That one you account for it in line with IS 37. Okay, you only make provisions for it. So there's a way I can ask that one. They will have told you the probability of and that there will be a return or that warranty you will pay it or something like that. They will give you those probabilities, then you will do a weighted and all of that to get how much you recognize as provisions. However, the second part is the part that the customer wants an extended warranty for additional 6 months. That one, but the company is not charging the customer because they believe they are new customers, they want to attract them. But if they are going to charge them, how much would the customer pay? 4,000 naira. That is a distinct performance obligation. Is a what? Distinct performance obligation on which we need to recognize revenue. So, in fact, for this transaction, there are two performance obligations. One is the goods or services itself that they sold for how much? And the second is that extended warranty. Okay, but in this case now, what is the transaction price? How much are we actually collecting? 196. That's the transaction price because that 4,000 we gave the customer for free. Even though it's a separate performance obligation, it's something that has a standalone price. It's an extended warranty. It's something they should pay for. But we decided to give them for free. There are two performance obligations here, and we need to allocate that 196,000 to each separate performance obligation. For you to recognize these sales under this arrangement, the goods itself, the goods, what was the standalone price for the goods? For the warranty, for the extended warranty, how much? Giving us how much? So we get a percentage. What's 196 of 200? 98. And this will be 2%. That means the transaction price now, which is 196,000. Abi? So what's 98% of 200,000? Was, sorry, 98% of 196. How much? What's 2% of 196,000? How much? So that is warranty. That is warranty. The third one, the third practical scenario I want us to look at. The third practical scenario I want us to look at. Let's look at consignment. Consignment. I can give you a scenario like this and ask you how would you recognize revenue on them. Consignment. And listen up, right? This is very common. When we say consignment, so a goods or services is on consignment if the transaction is with a dealer. If the transaction is with a what? Usually a dealer. And the key question here on consignment, are you with me? Consignment is if the transaction is with a dealer, those that buy in huge quantity and they will now resell. Okay? Those are dealers. Now, the key question here is this. to know how you recognize revenue or not is as control transferred to the dealer or not. As the control of the goods transferred to the dealer or not. That's the key question. Because when you look at those dealers, those people that sell cement, that buys in huge quantity from Dangote or Boa, or those people that sell Cokes and Fanta, all these beverages like that, that they buy in huge quantities from whatever. So the key question as an accountant is that this item you are buying in large quantity, we as a dealer, do we have control? The way you are going to answer it is one, if you are the one that determines the pricing of those goods or services to the customer, if you are the one that is determining the pricing. Number two is that if the entity can require return of those goods or services from you, if they will tell you that they can tell you to return those goods or services at any time. And number three is that if you don't have obligation to pay, if you don't have obligation to pay until you have sold those goods or services, then be sure that you don't have control. You don't have to pay until you sell. You don't have control. The person that sold the goods to you can say, yeah, return my goods. Or they can tell you that, give it to another person. You don't have control. It's the person that determines how much you can sell. He's the one that will dictate the pricing. You don't have control. So if you do not have control, that means in those cases, don't even recognize that item in your books at all. Don't bother recognizing any inventory in your books as a dealer. As a dealer. So the company sold or transferred goods to you on consignment, whereby they are the one that determine the price. They can require that you return it, and they are not forcing you to pay. They just want to put it in your location. You know, a lot of people, especially new companies, they just want to have the product everywhere. So they are ready to give it to people. You know that some people, when you go to all these, let's say ShopRite, for example, now, a lot of those goods there, ShopRite did not pay for it, and they won't pay for them until they have sold them. Those guys are ready to pay ShopRite to put their goods there. Okay, that's consignment. Okay, so if you work with ShopRite now, you will now not say that, okay, you have purchased, or maybe you now sold, you are now recognizing it in your books as revenue. No, it is not your revenue. So the major thing is this: how do you then recognize that goods you have collected? That's what we are even concerned about. So if you do not have control of those goods, don't bother recognizing inventory at all. But there are instances where the supplier will require that you do a deposit before they can come and put the goods. They'll say, okay, maybe pay 10%, pay something. Okay, they can say pay a deposit. But they will tell you that if you are unable to sell these goods, so we will return back your money to you. I mean, if you're able to, it's not like they're just trying to be safe. That, okay, you to do a commitment. They'll give you the goods, but do a deposit. That kind of deposit now, that is the only thing you account for. How do you account for that? Of course, you will have paid money. You credit bank. Do you know why you debit? Receivables. Because you can collect your money back. It's not trade receivables. It's other receivables. Not contract assets. This one is other receivables. Yes. For contract asset, that one is a right to consideration for goods you have. That one is a different thing entirely. This one is the fact that you did a deposit that you might collect back. You did a deposit that you might what? Collect back. So that is the only thing you account for consignment. Okay, if you did a deposit. But if control has been transferred to you, you're a dealer. But control has been what? That one, you recognize it as normal purchases. You read it against your inventory of purchases and you credit bank. Okay? But in most dealership relationship, you won't have paid everything. You won't have paid everything. What you will most likely credit is a trade payables. You credit what? If I hope you are jotting these things, though it's in your notes, but systematically the way I'm putting it, it makes sense to be jotting it down. So if control has been transferred, meaning you have control, the guy is as good as the guy has sold the goods to you. You debit your purchases or your inventory, and you credit what? Trade payables. If the guy says you should drop a deposit, that has only reduced your trade payables. That has only reduced your what? Trade payable. It has only reduced your liability if you are dropping a deposit. So it's like you're crediting bank, debiting the trade payables. Okay? And that is it for consignment. Please ask. Bye. Okay, so it is still a dealership relationship. Okay? But in this case now, the fact that the fact that Pepsi, because one, it's Pepsi that is determining the price, because these are retail commodities. That doesn't mean you cannot change the price. That doesn't mean you cannot change the price. So if you can do a conducive environment where darlings can come, lovers can come, you can charge them premium. They will still buy, even though you are a dealer. You know, there are some huge bars, all these nightclubs. They also buy in huge quantity. They can even register as a dealer. They will buy and they charge premium. So the price is really fixed. Once control has been transferred, that the entity cannot come and meet you and say, "Yeah, return my goods," or transfer it to another person, or probably you have a liability that you have to pay, that you must pay. That if you lost the inventory now, it will be at your own peril. You have to pay. That one you can charge whatever price, even though we know usually if I go somewhere and they say now I think it's 200 naira, how much is it now? I can easily go to another place. If this person says 500 naira, I'll say no, I'm not buying. I'll go to another place that says for 200 naira. Okay, so that's consignment. That's everything around consignment. Yeah, destroyed. See, when you don't have control, usually before anybody will give you goods or services, there will have been one contract or the other. Okay, but the assumption is that is the entity that bears the inventory risk. That's the assumption. Not that it cannot differ. It can differ. You people might that's why they will usually require that you do a deposit. Okay, especially in those instances. But if you say control has not been transferred, Abi, so they usually require that you do a deposit. So the entity is just trying to be safe too. In case you come and say, "Yeah, I can't find it anymore," it's usually the loss. It's usually a loss to the supplier, because the agreement is that just help me sell. It's usually for new suppliers that are still hustling. Okay, so just help me sell. Let me put it in your location. So if it gets damaged or lost, there will have been a contract that will have said how you guys are going to deal with it. But in the absence of that, it's assumed is the entity that will bear the damage. Good question. A contract, yes. Usually there will have been a contract on how to settle that. I didn't quite get a question, but I mean, ultimately, in business, that hardly would happen. Okay, that hardly will happen. And somebody, a dealer that wants to continue to be in business, will not ready to jeopardize being somebody that wants to put goods in your location. So if you mess up that opportunity, know that that will be your last opportunity, and nobody will want to do business with you. So those extreme cases, we really will not go there. But as far as accounting is concerned, the supplier had made a loss that they will recognize directly to P&L. It's like inventory loss. It's okay. No, not provisions. Not provisions. It's far from provision. It's an inventory loss. We'll recognize it immediately to P&L as an expense. But let that guy be sure that he will not smell our office again. We will not do business with him again. Right? Okay, but there were a lot to it, really. There were a lot to it. But I just want to focus on the core accounting issues around that. Now, this is number 3. Number 4 is principal versus agent. A principal versus what? Agents. So now, when you are into a transaction, are you listening? I kind of asked this before, right? So when you are into a transaction, you need to identify whether you are acting as a principal or whether you are acting as an agent. You need to seriously identify that. Because you being a principal, you are the one that actually have control of the goods. You are the one that actually transfers the goods to the customer. You being a principal, you are the one that do a lot around that goods, and you are the one that will ultimately recognize the gross amount as revenue. You being a principal. So I've seen several situations, several transactions. Like I have a client, right? So they are into logistics. They have an app, just like Uber, right? Where you can easily call from the app, somebody will help you deliver. Just that you pay from that app. You pay from that app. So when we were looking at their books, we wanted to audit them. We saw that all the money that people were paying for delivery, they were recognizing it as revenue. I said, oh God, this is not your revenue. This is not your revenue. The owner of this money is those guys doing the delivery. You only get a commission. Is that fees or commission that is your revenue, not the entire money? Say no, no. So what they do is that the money they pay to those their partners, they call them partners. They will now put it as cost of sales. They will put it as cost of sales. But the gross collection, they will say is revenue. Just that when investors, I mean, it's a tech startup, when investor looks at their book, they'll say, revenue is big. But no, that is not your revenue. Your consideration you are entitled to for the goods you have transferred is the fees. Is the fees. There's another guy that actually fulfilled the contract. That's the delivery guy. All these guys engaged in Uber now. Uber cannot recognize the entire amount as revenue that we pay. No, it's their, yes. That is what they will put in their books as what? Revenue. In fact, in the notes to the account on revenue, if you're an agent, you'll have done the breakdown. Gross collection, the payments to partners, net fees and commission, or gross collection, then a percentage of it revenue. That is one you go and put as your what? So you need to know, and it's always very clear when somebody is acting as an agent. It's always clear because you will see that the guy is not the one that will fulfill the contract. There is always a third party that fulfills the contract or that will do the job. He is not the one that will fix the price. There is always a third, though they will have structured an app in such a way that it ultimately determines the price. Okay, but if it's a website now, like let's say Jumia or Konga, where supplier will go and put their goods on their website to sell, it's the supplier that will determine how much they want to sell, right? So usually, Konga is just an agent. So it's the supplier that will determine the price of those goods or services. Another one is that an agent will never have an inventory risk. They don't have an inventory risk. They don't even have credit risk. They don't have what? They don't have credit risk. An agent. So those 4 things, those indicators will show that you are an agent, and the only revenue you recognize will be your fees and your what? And your commission. So when you have a scenario whereby you are just there helping to arrange the delivery of the goods or services, facilitating the transaction, that is a principal versus agent relationship. There's a scenario I want us to look at in the handout to strengthen our understanding of that. Principal versus agent. You're not writing, no? Principal versus agent. Okay, that will be on page 127. That will be on page 127. Who is reading? Who is reading? Yeah, to me read. Yes. There's a question on the principal versus agent.
Okay. An entity operates a website that enables customers to purchase goods from a range of suppliers. The suppliers deliver directly to the customers who have paid in advance, and the entity receives a commission of 10% of the sales price. The entity's website also processes payments from the customer to the supplier at prices set by the supplier. The entity has no further obligation to the customer after arranging for the product to be supplied. Is the entity a principal or an agent?
Now it's very clear there that it's very clear here that this entity is an agent. He's just arranging for the sales of the goods or services. He doesn't determine the price. He doesn't have an inventory risk. He doesn't have a credit risk. So all of this shows that he's an agent. And the only revenue you can recognize is commission, which he will ultimately recognize in his books, right? So that's principal versus agent. So all these arguments are the arguments you put forth when if you are asked a scenario like this in the exam. Now, another one. Let me do bill and hold arrangement. Let's do bill and hold arrangement. Let's do bill and hold arrangement. Now, for bill and hold arrangement, is a supplier sold goods, bill. He sold goods, bill. And he's still having physical possession of the goods. He's still having what? Physical possession of the goods. But the point here is this. The point here is this. The physical possession he's holding is usually at the request of the customer. Simply probably because the customer does not have a storage facility. He doesn't have where he will keep the goods. He now said, okay, let it remain in your custody. Okay? That is what we mean by bill and hold arrangements. So if they give you a scenario like this in the exam, do you know what has happened is that even if the supplier is not charging the customer, it is a separate performance obligation. That warehousing service or custodial service becomes a separate performance what? Obligation. So the key thing under bill and hold arrangement is that I've sold goods to you, but you said I should just keep it here in my warehouse for you. You will pay now. But if, because you're my customer, I'm not charging you, you as an accountant, okay, you have to take, if you are the accountant of this company, you need to recognize revenue for that custodial service. Okay, if they are not charging revenue for it, if they are not charging money, you need to allocate transaction price to it. You have to allocate transaction price to what? To that amount. And typically, that's the scenario you will find in an exam for bill and hold arrangement. Okay, where you sold to a customer, but the customer requested that no, leave the commodity in your warehouse. It becomes a separate performance what? Obligation. Now the last one is it can always be known. It can always be known because for a company that is able to do that for you, that means it might be offering such services to other customers. And even if it is not offering such services to customers, we can get those that offer such services to customers and we can know how much they charge. And that would represent the standalone selling price for that. Now, the last one here is repurchase agreement. I just intentionally, so all these things I'm saying are actually from, you're always sleeping with us. All these I'm saying are actually from appendix of IFRS 15, right? Appendix of IFRS 15. And there could be more depending on where you find yourself. But we just took the 6 ones that are not usually clear, that have complexity around them. We clarified it. Okay? So that's why I've clarified all the ones that need to be clarified. So the only one remaining is repurchase agreement. Now, I need somebody to give us an idea of how we can treat repurchase agreement or arrangement. What's the time? 9:30. Eh? I need somebody to give us an idea of how we can treat repurchase agreement. Repurchase. Do you know what repurchase agreement is? Exactly. You sold goods to somebody. You now agree with that person that you buy it back. Or from the name they call it, repurchase it back. Abi? Repurchase it. So how can we treat that kind of scenario? So how can we treat that? Okay, let's say the second part. Let's say the person can fix the purchase price. Okay, from the person, yeah. I mean, that statement I've already said a lot. If you don't know, it has actually said a lot. For the fact that you said that in the first instance, he has transferred risk and ownership. That's where we are. That's what we want to know. Okay, that's what this wants to clarify. No, it's far from it. It has nothing to do with that. Because you say earnings per share, right? Okay, okay. Under earnings per share. Okay, similar to that. Similar to that. But now we are dealing with tangible goods or services. Yeah, but it can be applied to that too. Okay, but those ones now they are not dealing with revenue or whatever. Now let me show you the entire picture. Just follow me. I'm not dictating. I'm explaining like that. So now repurchase agreement, right? You sold goods. You now agree that you can repurchase it. So there are 3 forms you can take. 3 forms. Number 1 is either you have an obligation. The entity has an obligation to repurchase. It has an obligation to repurchase. That means it must repurchase. Whatever the agreement is, obligation. Number two, he has a right. He has a right to what? Repurchase. A right to repurchase. That's the second form. The third form, he must repurchase if requested by the customer. If requested by the what? These are the three forms he can take. Obligation to repurchase, right to repurchase, and he must repurchase if requested by the customer. So there's a name for each of these, which some of you might know. Those that are doing SFM. Those that are doing SFM. When you have obligation to repurchase or to buy, what do we call that? It's a forward contract. You have entered into a forward contract with someone. You have an obligation, otherwise you will be breaking that contract. Obligation. That's a forward contract. That at a future date, I would deal. At a future date, I will what? I would deal. That's a forward contract. Obligation to repurchase. Forward contract. The second one is a right to repurchase. Somebody has given you the option to repurchase. That you have the right. You can come and repurchase. That's a call option. The third one is you must repurchase. If requested by what? By the customer. So that means somebody is ready to sell to you. This is a right to buy. This one is now somebody must sell. Somebody has an obligation to sell to you. Okay? That's a put option. So, whatever it is, I will expect an examiner not to be using these terminologies in the exam for you. They will express it this way. But it's okay for you to know what they mean in terminologies. Obligation to repurchase, forward contract. Right to repurchase, a call option. Right to buy. And somebody has an obligation to sell to you, put option. Now, let's look at it closely. Move closer. Forward contracts and call option. When you have obligation to repurchase, you have already entered into a contract with somebody that you will buy. Right to repurchase is your right. The person cannot say no. You see, in these first two instances, you did not transfer control. That goods you sold in that first instance, you cannot recognize it as revenue. You never sold. You did not sell because you have an obligation to repurchase or you have right to repurchase. You have not sold. You haven't. So you cannot recognize revenue in these two cases of repurchase agreement. You cannot. Then what do you do? What do you then do? So now, we need to look at it very carefully. Okay? In either of these instances, where we say that you have not transferred control, we need to consider, for example, now, if the repurchase price is, let's say, 1.1 million, and the original selling price is, let's say, 1 million. So you sold goods to somebody 1 million, the person paid you. You now told the person, I will repurchase it at 1.1 million. So how do we deal with this? And this repurchase, the examiner has to tell you, is there an obligation to repurchase? Is it a right to repurchase? Is it at the request of the customer? Because they are not the same. For these first two, you did not sell. This 1 million, you cannot recognize it as revenue. So that money you collected, that you're going to debit bank, what would you credit? That means that goods is still in your books. You cannot credit revenue. What would you credit? Sorry? What is it? I mean, the question is why? Abi? Because we are saying this is a loan arrangement. That's what we are saying. What we are saying is that you borrowed money and you are using those goods or assets as collateral. That's what this is saying. And why is it like that? The only reason why it is like that is because the repurchase price is higher. Why would you want to repurchase for 1.1 million? Something you sold to somebody for 1 million. The person has used. You don't want to repurchase it for 1.1? Oh, it was a loan. In fact, you debit bank, you credit what? 1 million. You debit bank with 1 million, you credit financial liability with 1 million. So ultimately, if you now repurchase it, if you now what? Repurchase it. Is this unclear? This 1 million naira, is it clear? Because we are saying that you sold something for somebody for 1 million. The person has used. You now want to repurchase it for 1.1. You say you have a right to repurchase or an obligation to repurchase for 1.1. That is a loan. For you to want to pay higher is a loan. And in fact, that excess of 100,000, do you know what it represents? Exactly. Interest. That's what that excess of 1 million represents. Interest. So now, look at it. I just want to show you the process. The original selling price is 1 million. You debit bank, you credit what? Financial liability. So the date for repurchase came. The person returned that goods. That one is not a problem because the inventory never left your books in the first place. Even though you have, but you did not transfer control. So you will not take the inventory from your books or the assets, whatever it is that you have sold to that person. It's not leaving your books. Debit bank credit liability. Now, the person came, returned the goods. How much are you paying the person? 1.1. Now, this 1.1, what do you do with it? You credit bank. With how much? You debit, what again? With how much? Then you debit what? How much? 100,000. Fantastic. This scenario when it's a finance arrangement, and this is what you should expect mostly. If I can decide to ask you today now, expect a financing arrangement because this is what is common for people. They just want to use it for shenanigans. The other one is not common. It's not what is common because it's possible that before I jump to the other one, hope this makes sense. This particular one. This one, expect this in the exam if they want to ask that. This is the one you were sure that they would ask. The one that you might not see in your exam is the other one because that one is not common. Okay? Is where you promise to repurchase it for, let's say, lower price. Let's say the repurchase price is 900,000. No, not put option now. I'm still in this instance now where you have obligation or right to repurchase. So you say you want to repurchase it for, let's say, 900,000. Okay? At a lower price than the original selling price. You want to repurchase it for 900,000. So again, the core thing is that the fact that you have an obligation to repurchase or a right to repurchase clearly shows that you have not sold. You cannot recognize revenue for that 1 million. You cannot recognize revenue. But in this instance now, for the fact that the repurchase price is lower, the repurchase price is, let's say, is 900K for the repurchase price. So something you sold for 1 million, you now say you repurchase it for 900. Okay, so that is not a loan. That is not a loan, because if it's a loan, you'll be paying more because you pay interest on how much you collected. So that one is not a loan. It's this one that is a loan where you are paying more. That means that excess you are paying is what? Interest. So this one is not a loan. So how can we interpret this one? How can we interpret this one? Because this one is not a loan. And it's not revenue. You have collected money, 1 million. We are saying it's not a loan. Simply because the repurchase price is what? Is lower. Is lesser. What do you think this can be interpreted as? No. Far from it. Far from it. IFRS 15 says it's a lease. Okay? So IFRS 15 says it's a lease. So we are saying that you lease your asset to that person. The person paid you 1 million naira. You lease your asset to that person. You collected how much? 1 million naira. So when the person has used, and used, the person returned your asset to you, right? So we are seeing that 1 million as a deposit. Okay, that I want to use his assets. So I will return it. So when you return it, we now gave him 900. Why did we give him a lower amount? Because that no reposition, that 100 naira is the lease rental. That 100,000 is what? Is the lease rental. Okay? So when I teach you lease next week, you will see the entire picture for this. You understand it better. But the way I want you to see this for now, for today, so that I just want you to picture it. That, okay, for the repurchase price to be higher, and you have an obligation to repurchase, or a right to repurchase, you have not sold, you did not sell, you cannot recognize revenue. It means it's a loan. That higher amount you are paying, that excess, is interest. That's that one. But for the other one, where you have obligation to repurchase, right to repurchase, but the repurchase price is lower, that one is lease. That one is what? Lease. So that reduced amount, that's reduction. We said is you have removed your payment. For the fact that you use my assets, this is how much I'm charging. This is how much I'm charging. So that's why there's a reduced what? Amount. That is for these two. That's how you deal with these two. Obligation to repurchase and what? Right to repurchase. But I'm drawing your particular attention to this one in the exam. For the loan, this is the common one you should expect in the exam. If I can wants to ask lease, they will ask pure IFRS 16 for you, for leases. But know that if the purchase price is lower, that is a lease arrangement. Now, the final one before I round up this class is this one. Where you must repurchase if requested by the customer. Where you must what? Repurchase if requested by the customer. Now, the key thing is this. Here, for this particular one, is that will the customer request or not? Because the customer might not request and he might request. So it's still the same thing. You sold goods to somebody for 1 million. This is the selling price. So, but in the contract, there is now the fact that, oh, the customer can return it. Oh. This is similar to sales on and right of return because it's at the request of the customer. Then the question is that since the customer can return, are we going to recognize this 1 million as revenue? Yes. In fact, we are going to treat it as an outright sale. Okay? Just that again, we are going to estimate a portion that might be returned and we'll exclude that from our revenue and we'll record it as a refund liability. Just similar to the way we have actually deal with it. So that's if the customer can return. And again, there's a lot of story behind that because based on the figures given, you should be able to determine whether the customer can return or not. Because it depends on economic incentives. Okay, it depends on how much are you ready to repurchase it. If you are ready to repurchase it for, let's say, 1.1 million, the customer will obviously want to request that you repurchase. Okay, so there might be an incentive to repurchase, right? So if there's an incentive to repurchase that the customer